Do you know what your balance sheet is really telling you? Here's a shocker. 65% of investors ignore it and miss huge red flags. Why should you care about a balance sheet? Because it's packed with insights. It helps you answer key questions like, can the company pay its bills? Is it growing? Is it taking on too much debt? A healthy balance sheet gives you confidence, but a messy one? Big red flag. We shall break down the balance sheet into the key components and show you how to interpret them using Apple Inc.'s balance sheet as a real-world example. This is Finance and Investment Hub, simplifying finance and investments for everyday success. What is a balance sheet? A balance sheet is like a financial snapshot of a company at a specific moment. It tells you what a company owns, assets, what it owes, liabilities, and what's left for shareholders, equity. And guess what? It has to balance. Assets always equal liabilities plus equity. With assets, what the company owns. Assets are what the company owns or controls that have value. Think cash, buildings, equipment, anything that can help the company generate income. Assets are divided into two categories, current assets and non-current assets. Current assets. These are short-term assets that can be converted into cash within a year. Examples include cash and cash equivalents, the money in the company's bank accounts. This is like the lifeblood of the business. Without it, you're in trouble. Accounts receivable, money that customers owe the company. If this number is too high, it might mean customers aren't paying on time. Inventory, goods the company plans to sell. But watch out, too much inventory can tie up cash. Non-current assets. These are long-term investments that the company will use for more than a year. Examples include property, plant, and equipment, PP&E. Think buildings, factories, and machines. Intangible assets. These are things like patents, trademarks, and goodwill. They're valuable but can't be physically touched. Now let us see how Apple's $352.6 billion in assets stacks up. Apple's assets. The what we own current assets. $143.7 billion. Cash and marketable securities, $166 billion. Apple's sitting on a mountain of cash. This gives them insane flexibility to invest, pay dividends, or buy back stock. Fun fact, that's more cash than the GDP of some countries. Accounts receivable, $29.8 billion, money owed to Apple by customers, like when you buy an iPhone on credit. Low for Apple because most sales are cash up front. Genius, right? Inventory, $6.5 billion. iPhones, MacBooks, AirPods waiting to ship. Apple's inventory is lean. They sell products fast. No dusty warehouses here. Non-current assets, $208.9 billion. Property, plant, and equipment, PP&E, $43.7 billion. This includes Apple's retail stores, data centers, and that iconic HQ. Fun detail, they spend billions on sustainability here. Solar farms, recycled materials. Cool and profitable. Intangible assets, $3.2 billion goodwill, $50.5 billion. Patents, trademarks, and the premium paid for acquisitions. Apple's brand alone is worth billions. But $50 billion in goodwill? That's mostly from buying companies like Beats and Shazam. Liabilities, what the company owes. Liabilities are the company's obligations, basically what they owe to others. Just like assets, liabilities are split into two categories, current liabilities and non-current liabilities. Current liabilities. These are debts that need to be paid within a year. Examples include accounts payable, money the company owes to suppliers, short-term debt, loans and credit lines due within a year. Accrued expenses, things like wages and taxes that have been incurred but not paid yet. Non-current liabilities. These are long-term obligations like long-term debt, bonds or loans that are due in more than a year. Lease obligations, commitments to lease property or equipment over a long period. Pro tip, check the company's debt levels. High liabilities aren't always bad if the company can manage them efficiently. Look at the debt-to-equity ratio to get a sense of their financial leverage. Non-current liabilities. What Apple owes. Again, split into current, due within a year, and non-current, long-term debt. Current liabilities, $145.3 billion. Accounts payable, $62.1 billion. Money Apple owes suppliers. Example, TSMC makes their chips and Apple pays them later. It's like a corporate credit card. Deferred revenue, $15.1 billion. Cash received for products, services not delivered yet. Think Apple Care subscriptions or pre-ordered Vision Pros. They'll earn this revenue over time. Non-current liabilities, $95.3 billion. Long-term debt. Apple borrows cheaply to fund buybacks and dividends instead of repatriating cash. Smart move with low interest rates. Equity. What's left for the owner's equity. This is the value that belongs to the shareholders after all liabilities are paid off. Think of it as the company's net worth. Key components of equity include common stock, the value of shares issued to investors. Retained earnings, profits the company has kept rather than paying out as dividends. Additional paid-in capital, money investors paid over the par value of stock. A growing retained earnings balance usually signals that a company is reinvesting profits wisely. But don't just assume that's always good. Sometimes reinvesting isn't as wise as distributing dividends. Apple shareholders' equity. The leftovers equity, what's left after paying off debts. Apple's equity is $62.1 billion. Common stock, $64.4 million. Retained earnings, $3.92 billion. Wait, only $3.9 billion? That's because Apple spends most profits on buybacks, $650+ billion since 2012. They're shrinking shares outstanding to boost your stock value. So what does Apple's balance sheet tell us? Liquidity king. Tons of cash to survive recessions or snap up competitors. Debt strategy. Uses low-cost debt to reward shareholders. Efficiency. Minimal inventory. Fast sales. If Apple were a person, they'd have maxed out credit cards, but also a vault of gold bars to pay them off. Balance sheet perfection. Key ratios for analysis. Now let's talk about some quick tools to analyze a balance sheet. You don't have to be a math wizard, just keep these ratios handy. Current ratio. Current assets divided by current liabilities. This shows if the company can cover its short-term bills. A ratio above 1 is generally good. Debt to equity ratio. Total liabilities divided by equity. It tells you how much the company relies on debt versus its own money. Lower is better, but it depends on the industry. Return on equity, ROE. Net income divided by equity. This measures how much profit the company makes for every dollar of equity. Higher ROE, more bang for the buck. Common red flags. Let's talk red flags to watch out for. High debt. If liabilities are much bigger than assets, the company could struggle to pay its bills. Low or negative equity. This could mean the business isn't profitable or is losing money. A shrinking current ratio. This signals cash flow problems. If you spot these, dig deeper. Balance sheet analysis might sound intimidating, but once you break it down, it's like solving a puzzle. If you found this helpful, hit that like button, subscribe, and let us know in the comments. What's the next financial topic you want us to tackle? Thanks for watching.